Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. We also have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to our next instalment of Nucleus Investment Insights. And today we're looking at the Cold War 2.0. I'm joined here with our head of strategy, David Llewellyn-Smith. Hello, David.
Hi, Tim.
And of course, Nucleus Wealth's Chief Investment Officer or Head of Investments here as well in Damien Klassen. G'day, Damien.
Hi, Tim.
So let's jump into it, shall we, fellas? We're going to start with a quick agenda. So we've got a quick market recap. We're then going to be looking into the Cold War 2.0, semicolon. We've got US goals, then looking into how it will play out. And then finally looking at as always, the investment impacts in of course, how we do everything every day at Nucleus Wealth and the Macro Business Fund by way of asset allocation and also the stock selection. So with no further ado, let's jump into it. And we'll kick off with a quick market recap. I'll hand over to Damien.
Yeah, thanks. Look, just thought, given it's such a big day in terms of the market movements, we thought we'd better add a little bit of commentary around it, because the falls in the market aren't all about the Cold War, and so it's worth noting, S&P off around 5%. Aussie shares, as the last I looked, were down sort of 6.5-ish. In terms, the Aussie dollar has sort of capped some of that, and so the MSCI World is in Aussie dollars is probably a better indicator for most of our subscribers and most of our investors. That's down off about 2.5%, so obviously considerably less. Our international is probably down about 2%. At last we saw probably a little bit less than that with currency movements. So I just thought there's a whole range of different things, different reasons for this coming off, and David sort of ran through a few of them in his note this morning. But we just thought it'd be worth sort of bouncing around a few of those, because while the Cold War, which we're going to spend most of this talking about, is very important, there are other things as well that are going into that. And I'll flip to David just to run through some of those.
Yeah, I know. Some of those are related to Cold War 2.0 as well, so it's certainly not irrelevant to it. But so the principal driver of the spike in volatility we've seen has been the sell-off in the US bond market, rising yields there, and that is related to Cold War in a sense, because it's being driven by a conclusion in the markets that the US will actually be stronger for longer than it expected, and partly that's a result of the tariffs placed on China and some of the repatriation of production that will transpire as a result. But there are other more technical things going on as well. I mean, every time we've seen a big spike in US interest rates like this over the last 4 or 5 years, more like 3 years, really since the Fed started to tighten properly, we've had a tantrum every so often, every time yields have risen, and we're having another one now. And what tends to happen with these things is a lot of very large technical traders and quant traders, risk parity models and CTAs, different very large players in the market get caught, chasing momentum in various sectors, and when you get a spike in yields, you get rotation into new sectors within the market, and these guys get their pants pulled down, and so you like we saw in February, even like when we saw in the various taper tantrums over the last few years, you kind of see a flush out of these momentum traders when we get to these points. So at this point, I'm not overly concerned by the correction. It doesn't appear fundamentally driven. Having said that, I'm well aware that markets lead fundamentals rather than the other way around. But at this stage, it looks like fundamentals are still pretty solid. The US yield spike has its own kind of natural endpoint to it anyway, given we've got this fiscal cliff coming in the US. So I don't really see the bond sell-off proceeding too far, and indeed the bids come back into bonds the moment this share market's cracked. So that kind of puts a natural limit on how much selling we will see.
And just to put into perspective, some of the how this risk parity sort of works generally is that is you basically you have an equity and a bond position, and you basically leverage up your bond position. So to increase the risk in your bonds to get it similar to the risk in the equities. And so what often happens is you see these risks you see your bond yield spike, and the risk goes up in the bond markets, and then the models then say, right, your risks are higher in bonds. That means you need to leverage down. You need to reduce your leverage, which from a pure quant perspective, basically sort of comes back to, well, I'm reducing my leverage in the bonds and all that type of stuff. But the net actual effect across your portfolio is you own equities and bonds and you're leveraged, and then you have to sell part of your portfolio and reduce your leverage, and that usually results in both sort of coming back. And so so that's sort of that. There's a lot of money behind this in its various forms. Some of them are very short term in their nature, talking about a couple of weeks and a couple of months in terms of the trading, and other ones are quite a bit longer term, and both of them are seeing signals that are telling them to wind back their exposure. And so they had that initial one in February, then because at the averages and everything take a while to sort of kick through. It took a we had a little bit of a recovery, and now we're starting to see some of that effect start to come through again.
Just a quick I guess more general question when it comes to these sort of big movements that we've seen like last night, and a quick plug for next week's podcast and webinar topic of volatility. But do you feel there might be a hand to play with the amount of index funds that are driving it? So we saw some pretty big movements.
No. The index guys, if anything, are helping to cushion this in terms of they when the markets sell off, they don't change. Some of the smart beta ones will. So because they're not market cap weighted, so some of those ones we'll see some movements. But the general index fund owns. So you've given them $100. They own whatever 5% of as part of their fund. They own 5% of Apple in that. Apple then falls 5%. But the weight in the market portfolio doesn't change, so they don't actually do anything with their shares. The only time they're trading really is around either corporate actions or changes in the index.
Okay, yeah, right, great answer. All right, no problems. So we'll zoom through into our next part of the recap, or I guess at the start of the Cold War. So we've got Bannon, Pence, and Bloomberg stories.
So just winding that up in terms of the relationship between the Cold War 2.0 and the current sell-off, there's a couple of other elements that we might consider connected. I suppose the oil price spike is to some degree related as well, given that's lifted inflation expectations. That's largely related to Trump's war on Iran, but that can be seen within this Cold War 2.0 context as well, Iran being a pretty serious Chinese ally. And so again, you have this sort of short-term fear over inflation. But anyway, moving on. So Cold War 2.0, I mean, the last time we discussed, sort of Sino-American relations, when the tariffs first arrived, we were hopeful that it would be resolved relatively quickly. We thought it was obvious that China was extremely vulnerable to this attack from the Trump administration, and that they would look to do a deal relatively quickly, given Trump is just full of bluster and is prepared to do deals. That's his modus operandi. It's very obvious now. And so, the sensible approach appeared to be for China at the time to just do some kind of, big deal that was going to help Trump in the short term, and then long term go back to what they were doing previously. And it turns out that that was an overly optimistic view. And
I don't want to say that. And then the second stage was in saying, right, we couldn't get a deal done immediately with the US, but it looks as if the US is picking fights with everyone. So let's now try and pick off some of the US trading partners like Europe or Canada and try and do separate deals with them while the US is fighting with them as well. And they were pretty much shut down by.
They were thoroughly rebuffed. Indeed, they were, and the reasons why will become clear in this first section. So we started to sort of doubt that simple explanation was, carried what was going on, as we saw, increasing rhetoric coming out of the US, a lot of it coming from the deposed Steve Bannon, funnily enough, who was arguing that this was going to be a much longer and more protracted economic war, not just a few tariffs, and it turns out he's right. His basic point was that the US, wanted to see global supply chains, especially around tech, repatriated either to the US or somewhere that was not a rival to the US. And then we've had, various, the tariffs, of course, and then last week we had what was virtually an open declaration of Cold War from Vice President Mike Pence, in which he just slammed China across multiple dimensions, including tech, industrial espionage, all of the South China Sea stuff, freedom of navigation, interference in domestic politics. Like, it really was just a 5-punch combination that in diplomatic terms was an absolute nuclear bomb. And so it's become clear that tariffs really are just a minor part of a broader US broadside against China. And now immediately following that,
and so it's worth adding as well. That was when we went, okay, we need to cover Cold War 2.0. Obviously, not knowing that it would erupt onto markets on the same day we're doing this.
Yeah. And so then we had some huge Bloomberg stories released in the subsequent days, and these, I mean, being a news person to some extent in my background, to me they just reeked of collaboration between the administration and Bloomberg. Like the White House had fingerprints were all over these stories, but they were industrial espionage stories on a grand scale where Supermicro, a Chinese Supermicro, is that what it's called? Yeah, a Chinese chip firm, semiconductor firm, manufacturer, was sprung or found to be to have allowed the People's Liberation Army, it's alleged, to put tiny little spy chips within their chips, which opened back doors for China to steal God knows what from whoever installed these chips. Now, it's alleged, of course, but there have been a subsequent series of stories with further evidence.
And denials, having said, there's been quite firm denials from companies involved, but there's I think they have 17 different sources, and
Bloomberg had more than an absurd number of sources for its stories. The denials, I think you can read as just basic sort of corporate risk management. They've got it.
Well, and potentially as well, they're related to, they might have been told by the Department of Defence or whatever to deny them. Like it might be.
They may well have, indeed. So you've got this sequence of dramatically escalating events that are showing that the US is going after China in a big way, which makes, of course, the original kind of shift towards tariffs just the first play in a much larger story. So what is the US goal? The goal in this Cold War 2.0 that they've now declared? The centre of it is tech leadership. Basically, this episode with Supermicro and various other hacks, software, hardware, etc., have convinced apparently both Silicon Valley, the Pentagon, and the White House that China is intent upon stealing US tech leadership. Unfortunately, China massively overreached in launching something called Made in China 2025, in which Xi Jinping basically declared his intention to steal tech leadership for AI, robotics, and just about everything else tech that you can think of. And that's part of the Great Chinese Reform Program, which is to shift China up the export value chain away from its low wage, low cost assembly model.
And it's worth adding as well, there's one more. That just today there's a Chinese spy arrested in Belgium who's basically stealing aeronautical.
Right.
Yeah, and so that's another, just one more wave in these same. It's that same, all that high tech area. So China's trying to get out of just doing the smaller parts, and now we want to be able to put planes and put, the latest technology together, AI technology together, and have everyone use that.
We just need someone else to design it for us. Is it?
Well, if we can if we can stand on the shoulders of giants. I mean, there's plenty of bright people in China, but it takes a while to get to the forefront. And if you can just start very close to the forefront and then expand on it, it's much easier.
Yeah.
Very delicately put there, mate. Well done.
So you have the US both trying to preserve its tech leadership and also prevent China from assuming tech leadership. Now, these things are sort of complementary goals in the sense of the US, because the US obviously wants to remain top dog in this huge kind of and strategic global industry, but just as importantly, it would like to prevent China from rising up this manufacturing value chain, which would enable it to escape, its debt, its current debt-driven growth model, right? Which is where we've seen, we've talked at length about how the domination of state-owned enterprises and debt-driven growth, most of it building-oriented, is now massive capital misallocation, has killed productivity growth in China, and with debt to GDP, some thinking around 350%, it's just simply bumping up against historic ceilings where you either run into a financial crisis or you simply begin to bog down as your debt servicing costs overrun your production.
Yep. Before we get into that,
we've just got a quick question as well. Sorry, I might have to swing that around. Thanks, Damien. So wasn't the US also accused of having backdoor technology into their chips and products?
Yes, is the answer. is the answer to that. Certainly, I think all spy agencies around the world are busy trying to hack each other's servers. I think the key issue from the US's perspective for what's happening in China is that it's not about whereas most of the US hacking and probably even Russian and other countries are doing the hacking. That's trying to get state secrets from each other, and what can I learn about your defense, and what can I learn about all these other things. I think the big issue for the US in terms of this is that this is actually trying to get into companies, steal the technology, and in China they've very much had that. You can come and set up yourself in China, but you need to have a local partner, and the partner needs to take the technology. And then there's been a few cases where then it's like, well, this partner that you had all of a sudden is a world leader in this stuff with all your technology.
Yep.
And so so the part was that it's the key issue is about the value chain. I think spying will be spying, and there's always going to be, you can't. Countries will be up in arms about it from time to time, but there's a certain element of that I think is generally accepted is going to try to happen. But it's the part about going, if you're trying to restructure your economy to be a world leader based on the fact that you're systematically going to try and steal secrets from the rest of the world and take those, that's where the pushback comes. And the other part is, I think that the key bit for me in terms of this value change, and we'll go into that a little bit later in more detail, but the overstepping is. In terms of this technology done at the manufacturing source is a big issue for Chinese companies, because when people hack computers, it can always be blamed as, well, it looked like it was the Chinese military or the Russian military or the US military, but it's always that, well, yeah, but maybe it was just a university student sitting in a hacking onto our Wi-Fi, doing whatever, sitting locally. It can always be blamed on someone else. I think putting these small chips on there's no way you can pass it off as, oh, maybe it was a uni student who got into the whole production process and put these in. I think a lot of the US stuff as well has done post-processing. I think this is what Snowden, the stuff we learned from Snowden is they like to go, okay, well, here it comes from the factory. If we can just intercept it and jump in the truck that's being delivered and add a few things, then off it goes. That's obviously different to saying, well, we're actually going to the factory and knocking on the door and saying, hey, we're going to add one more station to your production line, which is going to be, some Chinese military, inserting chips into your commercial things. It's obviously a much bigger deal than getting something in transit or already installed.
Okay, very good. And just the last one on the alliance network.
So this is where it gets a little confusing, because we've got basically raw power politics going here between the US and China, where the US is trying to preserve its hegemonic leadership. China's trying to undermine it. But Trump and the Trump administration are also Jacksonian. He is a Jacksonian president. That is from the tradition of Andrew Jackson. Now, that's a very different kind of president than we've seen for decades in the US. Most of them are Wilsonian in tradition. All of this stuff, by the way, comes from Walter Russell Mead, who's a brilliant historian of US geopolitics and presidential politics. The Wilsonians, are very much of the sort of US global hegemony school, where, they'll look after the global empire. In return, the client states open their markets, the whole Washington consensus thing, and US corporations move in, and that comes with its ups and downs. But the US state and US defence is the guardian of the overall system. The Jacksonians, though, are very averse to foreign wars, and so even though you've got this great power conflict now transpiring between Trump and China, it's quite opaque about what they think about the alliance network. If you had the Dems in power doing this, which we're kind of moving on to the next slide now, but the Democrats are likely to support this war of Trump's, because they've been very anti-China for a long time. If Bernie Sanders had won the election, we'd be seeing exactly this this kind of process transpiring, except he would be much nicer to the allies. And he's a Wilsonian, so this is where we get this unusual circumstance where you have the great power politics playing out between US and China, but the alliance network doesn't really know where it stands between the two, because Trump is equally rude to all the allies. So that's basically just at this point unresolved. We're not sure exactly, if push came to shove, how the administration would view allies reacting to the Cold War 2.0 in various ways with China.
And I'd argue though as well, he probably talks worse to his allies in terms of his words.
Yes.
But the actions are much nicer to his allies.
Yes, that's basically right. Yes.
Yeah.
Because the Jacksonian spirit basically is it looks for allied independence, if you like. It doesn't like this notion that it's a hegemonic power, upon which it must send its sons to, with M16s to defend everyone. It's very anti this whole spirit. It tends to come out of this sort of central and south of the US, which is where all the Marines basically are recruited from. And so you can understand why there's a groundswell of support behind Jacksonianism in the US, because, a lot of those working class people that have been marginalised by globalisation are the very ones that send their sons to die to defend it. And this is a point that Steve Bannon makes over and over again. Don't get me wrong, I'm not aligned with alt-right politics at all, but he's worth listening to on why this has been so resonant in the US. But anyway, moving on, the Democrats would actually support this and will support it, in my view, no matter who wins the House at the midterms and no matter who wins the next presidential election. So that means that this Cold War 2.0 is a structural shift, because I don't think, obviously the Republicans are doing it, and I don't think the Democrats will wind it back. They'd just be nicer to the allies along the way. So it raises the first point to make about that. Just a quick point on Australia, I guess, is we're really a meat in the sandwich here, especially with Trump doing it, because we've got China throwing potential LNG bribes our way as a way of trying to undermine the alliance with the US. But at the same, and you've also got Trump, throwing doubts into the alliance. But at the same time, if we actually take the Chinese bribes, we may just find ourselves cut off completely from the US, because you've got this Jacksonian spirit running the White House. So that's a by the by, though. So how will it play out from here? Well, it's a structural shift in our view. As I say, the Democrats will support it. Therefore, China's export economy is in trouble, is the first conclusion we can make. A lot of its low-cost assembly work that is driven by US corporations that invest there will get either repatriated to the US, the more sophisticated stuff that can be, for instance, automated, etc., or be shifted to safer US-aligned low-cost jurisdictions. So it's going to be quite a blow, we think, to the Chinese export economy.
Yeah. And the big part from that for me is, as I said, I spoke about that hackers and there was a plausible deniability. Like one of the golden rules of spying is you always need a plausible deniability. These chips that they found, it's very hard to have any plausible reason that it could be somebody other than the Chinese military putting them on. And so, which is why we think it's such a great overreach. And so the question now for all, you go through the major banks and you look at the boards of the major banks now, they will need to be asking the question, do we have any Chinese servers sitting in our server farm? Do we have anything that was actually not even a Chinese server, but anything that was installed or put together in China? And do we need to go through and now, do all these things, do all these checks and confirmations? And there's been, Bloomberg published a story yesterday or the day before about some Israeli security firms who are going through and doing exactly that, and finding in telcos, some more of these chips. And so the question will be for anyone who has client data that is sensitive, will need to then go, okay, I'm about to buy a new server from wherever. Do I buy a Chinese one, or do I buy one from Taiwan or Korea or somewhere like that? And even if it's 5, 10, 15% more expensive, well,
it's a security policy.
The cost of cleanup and all that type of stuff is just isn't worth it. So in terms of Chinese export economy, to me this is a bit of a game changer in terms of as this spreads and the word spreads, is you'll just have people, it'll just be a compliance issue. Same way as you run through your compliance of related parties, or you run through your compliance issues about security settings and who's got permissions and all that type of stuff is like, well, where did this hardware come from? Is there any chance that it's been compromised?
Yep.
And if so, go on to the next. And so for lots of people, it's just going to be way easier rather than saying, yes, we bought these servers from China cheaply, and then we had all our security exports go through them to make sure there was nothing on there that we found. It's much easier just to go, well, we didn't buy it from somewhere that went through China.
And just quickly before we move on to inflation, so we've got a reasonable semiconductor exposure, I think, in our international in the US. So how do you see that sort of playing out?
We'll go through that in some of the later slides. But my the broad brush of it is, to me, it's a long-term positive for these semiconductor stocks, and possibly even a bit of a short-term capex boom positive as well for them.
Okay, sure. So before we jump into the risk scenarios, we'll just cover off on inflation.
So you get trade diversion basically from these US tariffs that are going to get higher again in January, and they may get higher still beyond that into US aligned low labour cost countries. And as Damo has discussed, you're actually going to see China get punched in the head in the high value add stuff as well, so their entire export economy is going to take a blow. Now that intrinsically means a bit of a productivity downshift globally, and slightly higher inflation overall as that process transpires. I don't think it necessarily means lower growth. It could in fact mean higher growth in the short term, because you'll see a lot of new investment.
Could see some higher wages.
And some higher wages, yep. But it does mean that versus the counterfactual, you'll see slightly higher global inflation. That doesn't mean it's high global inflation, because, as we've discussed many times, global deflationary forces are immense. And in fact, you may see an offset immediately in Chinese overproduction of stuff, or there'll be a big deflation in Chinese product prices on the back of this. So. But net, a little bit more global inflation.
Okay, sure thing. Just one last, we've just got another question that came through. So are there any official legal channels that the US can pursue to make the issue of these effectively government sanctioned hack chips for China more difficult for China to palm off? So is there can the US go back to their allies potentially, I guess, say with the World Trade Organization or something like that, to make a point here?
Well, they're two separate questions. I'll leave the legal recourse to you, Damo, but I can say that they don't need to. For the first point, like the entire alliance network is now on red alert about Chinese stuff. And there
was already, we talked about, I can never pronounce the name right, but Huawei rolling out 5G networks. There was already a big pushback against that. There is absolutely no way that any country, in the US sphere is letting Huawei roll out a 5G network for them. It doesn't matter how much cheaper they give it to them. It's basically saying yes, we'll do it for you for free to subsidised by those government. They're just not going to take it.
And this comes back to the point that we made earlier about China's second phase attempt to address the tariffs when they first came up, and they tried to divide and conquer, going to Europe, Canada, and what have you. But they got rebuffed because everyone's on the end of this, right? And so, there's not really anywhere China can go with it. Everybody's afraid of getting their secrets stolen and their industrial prowess taken.
Well, that makes sense.
Europe was explicit about it when China courted it after the tariffs came, and just said, Germany, for instance, runs on IP. It has no interest in seeing China get off the hook here. It may have its disagreements with Donald Trump, certainly does, but it has no interest in joining China against this. It wants to be part of the solution.
And so answering the legal questions, I must admit, I'm not sure is the answer, but I concur with David that I don't think it really matters. Is that I think there's certainly been enough pushback from the US about a number of things, and so. Ideally from the US's perspective, I think when things happen, they do it through the World Trade Organization and other sort of global bodies. However, from Trump's perspective, he really doesn't care about a lot of this stuff, and he's basically more than happy to go it alone on saying, well, yes, I know we signed up to this, but we're still we're off and running on our own.
Yeah, okay, fantastic. So we'll jump into some risk scenarios here. Who wants to take the quick resolution one? Is this where Trump's headed? Is this with the bluster and then the deal sort of in play?
I think we're past that.
Yep.
That was phases 1 and 2, so I don't think we're going to see a quick resolution. I think that opportunity has been lost by China.
Mm-hmm.
Having said that, with the rolling out of all of these new, this sort of wider broadside, it does rather look like the Trump administration always had this in mind. So there was probably never a deal to be done. So we're into the second scenario now, which is twin Keynesian booms.
So put this into perspective, we've got a list up on screen, and for anyone who's not listening, I'll just read it out very quickly, and then we'll go through them. But it's basically in order of the quickest solution to the worst, to the longest, most drawn out one. And so what we've said is there's sort of 6 phases or 6 different risk scenarios, from quick resolution, twin Keynesian booms, escalating tariffs, outright sanctions, proxy wars, and then a real war.
Okay.
So we're into twin Keynesian booms, basically, where we've got the US going nuts on massive fiscal deficits. China's facing this big blow to its export economy, and so is rolling out what is now moderate stimulus.
Mm-hmm.
With accelerating monetary easing in reserve ratio cuts. They're still afraid to cut the actual cash rate. I don't blame them. The yuan will probably crash if they do. And as well, it's now clear that they are pumping out new infrastructure projects as fast as they can. So, classic twin Keynesian response in China to an external shock. And in the US, we think that, given the baked-in slowdown that we've got from its own tax cuts, that it's likely to turn to infrastructure as well at some point in 2019.
Yeah, and actually, just clarifying that in a way, we've sort of almost had a bit of a Keynesian boom already in the US in terms of tax cuts. It's not traditional government spending type one, but it's basically we've seen these big tax cuts sort of wash through the US economy.
Yep.
And then what David's saying is that's rolling off. The effect of that's starting to roll off. The tax cuts are still there, but the growth you got in terms of the tax cut. And so there's been a little bit of talk about whether there might be further tax cuts, and we've also, but the bigger one is we really haven't heard much on the infrastructure side at all, and we think there's a deal to be done with the Democrats on the infrastructure side, which is sort of that, basically you're going into a trade war, but in order to reduce the effect on your economy, you get out there and spend more money locally. And so what we're saying is we're expecting China to do that even more, and going to have to do that in terms of more construction and more infrastructure just to keep their economy ticking over. And then in the US, it's it's about the infrastructure side.
Yeah. Okay. So we're also into scenario 3 to some extent, and scenarios 3 and 4 are kind of almost one really, but we've got further ratcheting up of US tariffs baked in for early next year. China is rolling out its counter tariffs, of course, against various things, but because it's the surplus country, by definition it has far fewer opportunities to put tariffs on than the US does.
And I'd clarify the difference to me between the escalating tariffs and the outright sanctions is that the escalating tariffs is you keep adding to the percentages that's happening, and as David said, China's run out. The outright sanctions, though, is where China starts to say, well, no, we're not going to buy any American whatever. Let's pick soybeans, and we'll point to a disease somewhere that's happened or something like that, and we're like, right, no more US soybeans because of a reason that might be there might be some validity behind it, or it might just be a sort of made up reason about whatever that is. And you might find at that stage as well, the US officially labels China as a currency manipulator and actually says, okay, well, because you're a currency manipulator, we're now not buying this, or we're adding another whatever to the. So the outright sanctions is more about cutting particular industries and saying, no, we will not buy any from that.
Yeah,
And in a way, we have seen a little bit of that from China in terms of the oil side, which was where I think when this whole thing first started, David and I were very much of the view that it's very easy for China to fix their trade deficit, or at least their what you call their bilateral trade deficit, by just importing a whole bunch more US oil and letting oil that might have gone somewhere else, you pay a little bit extra for it, but you fix the problem of your deficit there. You create deficits elsewhere around the world, so there's no real particular gain, but it would have given a nice saving face to Trump. But given they've sort of they've actually looked like they're all going the opposite way, where they've not bought oil from the US recently.
Okay.
So the other difference between escalating tariffs and actual sanctions or boycotts is that I think the global economy can take escalating tariffs. It can't take outright boycotts. If China responds to escalating tariffs with a boycott of US goods or of some sort,
a broad boycott, as opposed to a sort of
a broad boycott, and it starts telling its people not to buy Apple phones and etc., then if the US were to do the same, then the Chinese economy would get absolutely smashed.
And I was going to say that. So because obviously in these sort of wars, someone's always got the trump card, so to speak, or the better card. And in this case,
look, they're both losing in that scenario, but China loses more. So, but the key point is the global economy gets crushed if that happens. I mean, you get the whole, the long chimeric phenomenon simply unravels, in a shock. And so
China's reason for going down this path, though, you sort of when you look at it this way, and as David is saying, it's bad for China, much worse for China and all that type of stuff, is you go, oh, why would they ever do that? That's crazy. Take that off the pages. It's never going to happen. The reason for them doing it is because there is quite potentially a view in China that American politics has never been more fractured. And that if China applies pressure, that the Democrats or the Republicans, you'll splinter. You'll basically get the two parties at each other going, whatever it is, you have a little bit of a downturn because of this effect, and all of a sudden each party's at its throats, going and fighting over, who's gonna keep going versus who's gonna submit, and so their view is a view in China is that because America's so fractured, then they're vulnerable if they go down this path to then succumbing and China getting what it wants. The flip side is that nothing unites warring parties better than an external enemy. So,
a common enemy.
It would be a huge blunder if they do it. In my view, I mean, it wouldn't work. Is the problem? I think the American people would rally to their president immediately, and you would have exactly the same in China, and both countries in massive recession with, it'd probably be the path to a hot war pretty quick. So I don't think China would do that, but it's definitely a possible scenario. If as Damo says, you could rationalise that as a way of winning it. It's just such a massive escalation that it'd be extremely dangerous. And from there we do start to push towards hot wars. Proxy wars is the first cab off the rank. I mean, in the nuclear age, it's very difficult to see great power conflict because it,
can end very quickly.
It can end very quickly, as they say. In the nuclear age, the enemy is really war itself. So
and there aren't really too many proxy wars sort of on the. I mean, maybe you could get something funny in something going on in terms of China, India over various disputed territories.
It'd be all in North Asia. I mean, Taiwan Straits,
North
Korea, but here you're again into the sort of mysterious input of the Jacksonian president, who simply wants out of all of these strategic commitments.
Yeah. And all those people we mentioned, ex-Taiwan, all own nuclear weapons, and so it's not like you're a proxy war in Afghanistan or Syria or somewhere like that, where you are dealing with parties where proxies on either side supporting each side, but it's a conventional war as opposed to
possibly Iran or somewhere you might see conflict. I mean, if they're incredible. The US is very the Trump administration is very hawkish on Iran, but it's a major Chinese ally. They could just simply up their oil purchases and completely trash the US sanctions on Iran, leading to conflict of some sort on the ground. Hard to know, difficult to know. And then, but I guess in this context, we have to mention the other escalation that was mooted last week by the US, which is PACCOM. That's the Pacific Command of the US Pacific Fleet. Leaked that it was mulling doing these enormous military exercises directly in the Taiwan Straits.
Yeah, right.
And that's all freedom of navigation stuff. It's fuck you, Xi Jinping, and your little islands spread around the South China Sea. But it's all in this broader context of just Chinese containment, I guess you would call it. So real war, this setup, in historical terms, has often ended in real war. Where you have a great power, a hegemonic power, and a rising power challenging them, and we know all about, Thucydides' trap and all of these things. So, possible outcome, yes. Hard to plan for. Difficult to see how it goes. Just pray it doesn't happen, because it would be literally the end of Australia. Australia, there's still a 70% direct support for the US alliance, I think, in the Australian public. Very sceptical of Donald Trump, but the commitment to the US alliance is still very strong. And the fear of, there's obviously a great deal of goodwill towards China economically, but there's also a lot of fear about China's strategic power in the surveys. And so I think Australia would be forced to choose the US. And the economy would collapse. You then come out of it, of course, but doing other stuff. But we don't really want to end up there.
No, definitely not.
When you're sort of refusing to sell your iron ore and what have you, and you're into pig iron bob and all that stuff. So we just hope it doesn't end up there.
Okay.
So yeah.
Every now and then, on moments like this, I feel like I need the Lifeline 1-800 number. But
well,
anyway.
as I say, I don't think that's a likely outcome. And in the nuclear area in particular, hopefully saner heads would prevail long before we got there.
It turns into a saber rattling contest, and then someone backs down potentially. All right, very good. Well, that's the end of the risk scenario. So let's jump into the meat after the potatoes in what we're doing every day at Nucleus Wealth. So we'll start off with some asset allocation. So how are we looking, Damien, in terms of we're setting up for everything we've just spoken about?
Yeah, sure. So look, we're already pretty well positioned for most of these themes. It's I think certainly in terms of escalation, we'd been it had been certainly on our base case that we were having that the tariffs were there. The next round was going to come, and so I think at the start of the process we probably misjudged it, but we certainly changed that over the last few months and have been sort of repositioning our portfolio for events where things start to slide. So I think in terms of an equities versus bonds, I think the bond side, there does seem the case for some slightly higher yields in terms of inflation and the potential for these twin booms, which I think is sort of the most likely outcome at the moment still.
Mm-hmm. And when you say bonds, obviously our bonds that we use?
Mainly international bonds. So I think the Aussie bonds to trade on a number of different factors. One is the local outlook, but there's also sort of a relative argument in terms of relative long bonds. And we've seen the US long bond sort of move from, well, pick your time frame, but most recently sort of from 2.9-ish to sort of 3.25 for some of the longer term bonds. And that's sort of been a lot of the drive of the market starting to come off, is this fear of this bond, this bond rally. There's
bond crash.
Sorry, yes. We think that the economics of it is still in terms of Australian bonds is still that the risk for Australian bonds remains that the yields fall further, and that the Australian economy is Australian economy is vulnerable, and it's not in a good position, not in a strong position at all. And so, if external forces conspire for a bit of an economic downturn, or things get worse internationally, that we're going to see a lot of pain in both the Australian equities market.
It's important to note at this point that one should really discount the headline numbers in Australia at the moment.
Okay.
Like they're quite good at the headline level, but domestic demand is far weaker than it appears. That's largely because immigration is so high, which is boosting the headline numbers, but per capita numbers are much more weak. And it tells you that basically if there was any kind of shock, then there'd be mass retrenchment in households, with falling house prices already accelerating. And although the labour market's been red hot over the last kind of 18 months, even that has been driven by a lot of temporary spending, which is already plateauing. It's not going to fall. Well, some of it's going to fall actually in the housing market, but housing construction, that is. But things like infrastructure spending and the NDIS and what have you have peaked more or less. They're not going to fall away, but they're not going to add to growth either. So it's just a point to note that we're talking about bonds and interest rates. The Australian economic strength is far weaker than it appears.
Right. Yep.
Yeah.
Which is why the RBA's just been completely unable to hike.
And so that reflected back into our portfolios?
Yeah, so we've been minimum weight Australia or close to minimum weight, sort of bumping along the bottom in terms of our weight for Australia for a little while. We actually had to buy a little bit more. So within our tactical portfolios, we've got limits that we're allowed to push for risk management purposes.
Yep.
And we've been pretty close to minimum weight Australia, and when Australia falls a little bit further, sometimes that carries us under our weight, and we've got to buy a little bit more to bring us back above, and so that's happened a little bit recently. So we're pretty happy with our positioning there. I think it's worth noting that Australian market's been hit a lot harder over the last sort of month or so than international markets, and the performance over the last year has been 10%-ish worse, and just in the last few months we've seen. After today's move, we're probably, I don't know, in Aussie dollar terms, we must be 4 or 5% worse than the market just in the last month or so.
Wow. Yeah.
But with an international. And then on the bond side, we've had some bonds, but we've sort of been we're a little bit overweight bonds. We'd wound that back a little bit recently just because this feeling that the US bonds were starting to rise, and that while we sort of feel as if Australian bonds will end up lower, that there is a little bit of potential for them to move up first. So we're overweight still, but we're not as far overweight as we were earlier in the year, and quite possibly, if we see bond yields, we're certainly looking around, sniffing around for if rates get higher than what we think is the right level, we'll pick up a few more bonds.
Yep.
And mostly just switching out of cash into that.
Okay, sure thing. And then jumping across into the stock selection. So we touched on before, we've had a little bit or reasonable amount of American semiconductor exposure.
So this is where the Cold War 2.0 really comes into it. Is stock selection within markets, various markets around the world, because if you do if this is right, if we're right and we are going into this new Cold War, is that there are quite stark sectors that are going to be winners and quite stark sectors that are going to be losers.
Sure. So
for the first one, the tech sector. Now, interestingly, the tech sector has been hit quite hard over the last, since this Bloomberg stories broke. That had the worst of it last night, and the tech sector last week, as the story hit, the tech stocks were off sort of 2 or 3% generally as well. So in my mind, that's the wrong. In a relative sense to other stocks, that's the wrong reaction. Is that the biggest threat to most of these tech stocks, the biggest existential threat for most of them, is a Chinese competitor that comes in and wipes out your market. So if you're a semiconductor and China's gone from making the very simple sort of commodity products, and they're moving up into the more advanced chips, and that for your AMDs and for your Intels and all these sort of various chip manufacturers out there, their biggest threat really was that all of a sudden you have a massive or a number of massive new competitors come out of China. So,
which for reasons spoken about, probably doesn't look great going forward.
No, that's right. So from my mind, they've all been given a bit of a reprieve in a way, saying, okay, now we're on the case, and it's actually being pushed that this isn't going to be allowed, and more so than that, it's now a major security issue for a lot of people to be using non-Chinese chips. I actually think that whole tech sector, well, not the whole tech sector, but there's certainly elements of that are much better positioned for the longer term now than what they were 2 weeks ago.
Fascinating. Yep.
So the tech. I don't know if you've got anything else you want to add on the tech sector, David.
No, I just I completely agree with you. I think the blowback against Chinese tech is going to be immense.
Yeah, and then you flow through a number of ones, Apples and things like that. There's the joke for buying a ZTE phone was, you get a more efficient phone because the Chinese don't need to hack it before it becomes pre-installed with all the software to hack it. Whereas, the thought now was a joke before, and now the question is, well, is it a joke? And so. So for your Apples and Samsungs and people like that, I think there's a huge benefit of not having to face, or certainly not facing as much competition from low cost handset manufacturers.
Just a quick one on that, just while we're sitting on the tech, just sort of flipping this on its head a little bit. Do you think there's an opportunity for a new market for American or non-Chinese made sort of chipsets, for want of a better word, in China? Given the fact that there might be for anybody,
No,
you don't think there's anything there?
No, I think it'll be supply. Like for anyone in a serious security issue, it will be, where is your supply chain? What are the checks? What are the balances to make sure that this stuff isn't happening? And for the large part, if you have a factory putting these things together in China and you've got all your controls in place and all that type of stuff, and somebody has a factory in South Korea or Taiwan or Vietnam or something like that, it's just, all of a sudden you're one step higher. It's like, okay, do I have to worry about all the compliance bits about making sure that, because in the end, if the Chinese military turn up to that factory and say, you're not allowed to tell anyone, and we're putting these into these chips, and you'll get shot if you tell anyone, it's going to happen.
Yeah. Okay.
So the other thing in the tech sector, the big ones, Googles and Facebooks and versus your Baidu, Tencent, and I've got an Alibaba as well.
Yeah.
Yep.
So those. Your biggest threat to some of those companies was, will the Chinese, and we spoke about, we went through a whole podcast on this, and we sort of come to the conclusion already that we didn't think it was likely that these Chinese companies would be able to expand into Western countries, but it was always a risk, is that they're big enough and they've got enough money and enough technological knowledge to actually be able to make a concerted push into other markets.
Yep.
And the question now is, if you had a great search engine that happened to be Chinese, and you suspected that whatever you were typing in was being saved and whatever, even if it is better than Google, or 20%, 30%, 40% better than Google, I still think a lot of people will go, no, given this outcome, I'll just go to Google.
Yeah.
It doesn't matter how much better the Chinese search engine ends up being.
Yep.
And then also questions about, what will we actually be, we might have a WeChat or whatever it is that might be better, but will you actually even use that when I can use one that's not? So, So tech sector, generally speaking, I think long-term positive for coming out of this. Defence stocks, there's going to be more spending. So, I mean, we've sort of been positioned for this already. A number of stocks in our portfolio, which actually, the issue I've got is a lot of these defence stocks are getting expensive, and so we've sort of been. We let go a little bit of some of them recently just because they are getting so expensive, but there is certainly this push for both Trump complaining about how much Europeans are spending on their tech, on their defence, and also just an up in terms of the defence stocks within the US, whether it be just that there are things that have been sold to defence departments and someone turns around and says, that's it, no more Chinese manufactured things anywhere. There's and that sort of comes into that CapEx spend that's sort of on this list as well, is that just a
big rollout, a big refresh of everything.
And that's the tech sector as well. You know, if you're running a big bank or a small bank somewhere and you've just said, yes, we do own all these Chinese servers, and you're saying, well, it's going to cost us $10 million, $20 million, $30 million to replace it all, but let's just bring forward a bit more of our spend. Then you get a bit of a benefit from there.
Okay, exporters.
Exporters so exporters is a bit all over the place. As David was talking about before, it's good to you would like to be an exporter in a country like Mexico. So if you're a relatively low cost nation, you're within the US sphere of influence, and you're going to pick up you're going to pick up factories and things like that that are moving out of China, or it might have been planned to be put in China, and now it's not going to go into China.
Yep.
So so if you're a low cost if you're in a low cost jurisdiction, then and you're an exporter, then that's probably a pretty good thing for you. A number of currencies have really been smashed. The Mexican peso wasn't one of them, but some of the places like Brazil maybe. I've sort of got the beneficiary there, and potentially places like Australia, if currency was lower, you'd sort of be more positive on that in terms of Australian exporters as well.
Okay, yep, sure. So oil and gas.
Yeah, oil and gas is a tricky one. There's actually probably two elements to this. On the oil side, you could argue demand will probably be there's two arguments on the demand. One is if you've got this twin Keynesian boom going on, then maybe there'll be greater demand. On the flip side, maybe because of all the tariffs and everything, you actually get a bit of lower demand in terms of that. So there's one issue there. The other thing on the oil is Iran, which is the major. US is looking at some major sanctions on Iranian oil. Is that the hotter this runs, the more likely China is to flout those sanctions.
Yep.
And so if there's 1 million barrels a day that keep coming out of Iran because China now basically takes everything that Iran's got to give, then that's a negative for the oil price. That there's just more supply out there. What else can we say with oil, David?
Well, the other dimensions are gas, really. I mean, you would think that China's plans to invest in and rely more upon US gas are getting more and more troubled by the minute. So I would expect that to probably benefit Russia most of all. They've already got one huge pipeline under construction. There's a second that's kind of been shelved, but wouldn't be at all surprised to see that come on stream much quicker than otherwise. And that would be obviously negative for seaborne LNG. The counter tariff that China put on LNG was pretty small, 10%, really wouldn't make any difference to anything. Certainly not enough to slash the margin of US gas into China, and that may well be an indication of China's reliance on US gas. So, would they ramp that up further? Hard to know. I mean, there's certainly, they've mandated that they have to get to 10% gas power output by, I can't remember the date, I'm sorry, but that is a huge undertaking, and it will be impossible without US gas. So, they're a bit between a rock and a hard place there.
Having said that, though, I mean, I think in terms of gas bouncing around, maybe it ends up China starts buying all the Qatari gas and
yeah, that's possible, absolutely.
And the US gas just ends up in Europe where the Qatari gas was going, and everyone pays a little bit more for
Yeah, that's plausible. And in fact, that indicates the sort of geopolitical structure that might come out over time in the entire kind of global trade network, where you sort of end up with two hegemonic trade systems where that kind of cross over but are discrete at the same time.
The question is almost basically everyone pays a bit more for transport costs in terms of shipping it around. You just ship it a bit further than what you would have ordinarily done because it doesn't go to the market closest to you because they're under either China or US's influence. And
for Australia, of course, it'll pose an interesting quandary because the Chinese have openly offered to bribe us with more LNG gas investment, but take it directly from the US and give it to us. And I just see the White House responding very favourably to that. So even if the Chinese do try to do those deals, I'm sure there'll be a phone call from the White House that would make it very, very difficult for it to transpire. But that's just Australia's balancing of these tensions. I really don't know what interest on any given day is going to win that battle. Yeah.
And the last one, resources. So I guess we need to wind up.
Time is getting away from us. Yeah, sure.
The resources side is interesting in terms of if China really starts to lose out on the industrial front, in terms of people pulling exports from China, they're going to have to ramp up their infrastructure and their housing spend to keep their economy ticking along.
Yep.
And so it's a very short-term game, but potentially there's a greater demand for some from the Australian resources in terms of that. In that if they can't pull the levers to get their consumer going, and they can't get their and they're losing out on the whole manufacturing base, is that the next, their tried and true way of getting their economy going is to throw lots and lots of money at the housing and infrastructure markets. And it looks like they're starting to do that. Maybe that's a very good thing for Aussie resources. So we sort of moved, we were very underweight resources 6 months ago, and so we've wound that back a bit. That's probably one area where we're looking at, over the next little while, is what we do in terms of that market. And it's not I don't think certainly wouldn't be particularly overweight that, but I think there's we don't want to be a long way underweight resources.
We've kind of got a bit of a buy the dip watch on it, because even so far the bulk commodities have hugely outperformed the industrial metals, for instance, because it's already clear that China's moderately stimulating, so that demand's going to hold up even if other parts of the Chinese economy fall away. That said, if this really accelerates, that won't last.
That's right.
But if you put together the twin Keynesian boom scenario for next year, because there's enough stimulus coming out of China to hold things up next year already, and if you add some US infrastructure to that, you'll get quite a tailwind for resources. It's not that, in real terms, it's not that big, because US steel is nearly all recycled, but it'll be a big sentiment lift to the markets around resources. So we're reasonably positive on them for 2019.
Okay, all right, very good. And just on our final one here, so just as to wrap up, in a nutshell, what have you got for us?
Changes?
Yeah.
Look, I think given we're largely positioned for this outcome, we've got lots of cash, and the question is, do we actually get out and start deploying it? Not yet is the answer. As we're looking at opportunities. I think in terms of stocks themselves, there's certainly a number of ones where we're going through and starting to go through the trades at the moment. The thing when you get market shakeouts and certainly big market falls like we've seen over the last few days, is what a lot of these momentum following strategies tend to do is they tend to be in the largest and most liquid stocks. And so once they all turn and they start to sell, it's a bit indiscriminate in terms of what they're actually getting out of. And so what you quite often find, and this case is no different, is that some high quality stocks get sold at this point in the cycle. And then what happens is, over the next few days, people start switching out of their low quality stocks. They start going, well, geez, just a minute, the market's down 5%, and I own this low quality stock that only fell 2%.
Yep.
And here's this high quality stock that fell 7%.
Yep.
I'm going to switch positions and pick up a high quality stock for a cheaper price. And that's where the value is that we're sort of going through now, going, okay, where are the high quality stocks that we've been watching for a while and we wanted to buy? Where can we actually deploy some money in those? And some of these stocks that haven't actually traded as far down as they should have, just because they're not as liquid, which ones of those can we switch in? So market volatility often begets this that quality, that chance to lift the quality of your portfolio, just because of the indiscriminate selling while we have the volatility.
And there's, I guess there's just opportunities around, so it's finding the right time at the right price.
So I'll just add one final point, just to wind it up, I guess, and that is we are intensely aware that it is late cycle. We've been sort of calling an 18-month horizon to a possible global shock now for a couple of years. That hasn't happened. It's been palmed out by various things, but as a result, our equity allocation is much lower than it would normally be.
So we've got 3 times as much cash in our growth portfolio, our biggest one. We've got more than 3 times as much cash as we'd ordinarily hold.
Yep.
But at this stage, our base case is that's more likely, an end of cycle shock is more likely in 2020 than 2019.
Wow. Okay. Yep.
Basically because our base case is this twin Keynesian boom scenario.
Yeah.
But I'm simply making the point that we're well aware of the alternative risk scenarios.
Yeah. And the biggest risk in my mind, I don't know if David agrees with me on this, is that the Australian economy is vulnerable. We are seeing falling house prices. If equity markets had a big pullback and that started to flow back into economies and capex intentions and things like that, is that maybe that's enough to tip Australia further into into a larger housing crash and things like that. So it's not a base case at the moment. We still think we're a while away from that, but we certainly recognise the Australian economy is vulnerable, and with a decent sized external shock, it's really vulnerable. And so the question is this going to turn into a decent sized external shock? At the moment, probably not, but the risk is certainly there.
Okay, fantastic. All right, and so now let's hear a little bit about Nucleus Wealth. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com. Okay, so a marathon session there on a massive topic. I hope you got something out of it. I certainly did, and there is plenty ahead. And in actually following on from today's one, where I'll let you know that our next webinar topic is volatility explosion, and as we've seen last night in the US markets, I think it's quite timely. Same bat time, same bat channel, so the Thursday the 18th of October at 12:30 Australian Eastern Standard Daylight Savings Time. If you're interested in that one, please head over to proton.nucleuswealth.com to register your interest, and we can take it from there. So as always, we are available on iTunes and Podcast Addict, or wherever you get your quality podcasts from on Android. If you like us, feel free to give us a review. I should say, we should probably just give a review anyway, but if you can, please do. And the more stars you give us, the higher it moves us up in the ratings and helps us get our messages out there and I guess get in front of more people. You can also check out bit.ly/Nucleus Insights, gets you across to the relevant podcast pages. So just finally, as always, thank you very much for attending. If you'd like to complete a survey on how we've gone today or suggest some new topics, topics, head over to bit.ly/Nucleus survey with 2 S's in the middle, where you can fill out our survey page, give us a bit of feedback, drop in maybe some topics you're interested in us researching and delivering, and we can take it from there. So on that note, thanks for your attendance, and we'll look forward to catching you at the next one. Cheers.